So what's the first thing homeowners do before putting their house up for sale? They fix it up, right? From roof all the way down to the ground floor. Well, Jack Kasprzak, he is an expert in this field, managing director at BB&T Capital Markets. He follows building material stocks as well as other industrials. And he joins us from Richmond, Virginia. Jack, good to have you with us.
Thanks, Pimm.
All right, Jack, let's talk about the company. I want to get your thoughts on Beacon Roofing Supply, BECN. Is this a little bit of a contrary play in a way, right? I mean, you want to sort of get onto Beacon before the real housing, I guess, resurgence really takes over the headlines. What's the story with Beacon?
Well, you're right in the sense that Beacon's business putting shingles on roofs, supplying the people who put shingles on roofs, has been down for 3 years in a row with the housing market. In fact, it's the first time since World War II that residential roofing demand in terms of volume has been down 3 years in a row. So it's been quite a dramatic decline in the market. But with the housing market improving, we think it hit bottom in the mid to late summer. Various metrics indicate a slow but sure improvement since then in the overall housing market, that perhaps 2010 and beyond could see some improved volume trends for Beacon.
Now, Beacon has got sort of this desire to become a national company, right? Explain the strategy.
Sure. The core demand for roofing materials is really over time a reflection of GDP, so maybe 2 to 3% growth. To augment that growth, Beacon has embarked on a strategy that includes acquisitions. It's a fragmented industry in which they operate. There are certain areas of the country which Beacon doesn't have much of a presence at all, for example, the West Coast. So there's an opportunity for them to go around and buy up other distributors of roofing materials and complementary products to help augment their growth.
Now, how have they been able to beat estimates from the street like every quarter since the third quarter of 2008? How are they doing this while at the same time sales are going down?
Well, if you rewind before 2008 into 2006 and 2007, it wasn't such a good time. The industry was plagued by higher asphalt costs, which were a reflection of higher oil costs. I think probably everybody knows that story. After that, during 2008, the industry embarked on a series of price increases to try to catch up with the higher raw material costs. That benefited Beacon during 2008 and into 2009.
Now, what about margins right now? It looks as though they're maintaining those margins, right?
Pricing has held firm. There haven't been any price increases recently since probably the spring, but there haven't been any price decreases either. So they've held pretty firm over the last couple of quarters, and estimates have remained pretty subdued.
What about their cash position right now? What do they got? A little bit more than $80 million in cash, so they could start to go out and make some small tuck-in acquisitions?
Right. That's what we think is pretty interesting about Beacon right now. They haven't done an acquisition of any major size in 2.5 years. If you go back to when they made that last large acquisition, they were arguably even a little over-levered. Since then, they've paid down debt. Cash has built to that $80 or $90 million lever, as you say, and they seem very well positioned, I think, in 2010 to restart the acquisition engine.
All right. Now, Beacon shares right now about $16.50 for BCN. You like the stock at 20. You think it could be worth as much as that? What kind of multiple are we talking about? A 20 multiple on estimated earnings?
It'd be a little less, high teens on estimated earnings. On cash flow, the stock currently trades at 7.5 times, which, if you look back since Beacon has been public, is actually below the average for the company. I think the average is more in the 8 to 8.5 times cash flow range. So it's still trading a little bit below historical averages, and you haven't seen a recovery yet in the overall volume of the business. If that happens in 2010 and 2011, you could have a very nice growth rate in earnings for this company.
Now, this growth that might take place, would that cost the company anything, or is this going to drop right to the bottom line?
Well, I'm sure you hear with a lot of companies, utilization rates are pretty low. Demand has been weak. Companies have cut back. They're basically waiting for volume. The first amount of volume that comes back to this business will not have a lot of costs associated with it, we don't think. You should get some nice incremental margins from that.
All right, let me turn your attention now to what's going on with another company that you follow, Jack. I want to get your thoughts on Great Lakes Dredge and Dock. Now, this is a company that gets hired a lot by the Army Corps of Engineers, and you say that's still a little bit of an unknown. They don't know exactly what kind of spending picture they're going to get.
Well, the Army Corps of Engineers did get an allocation of dollars from the stimulus program. But as you hear with some different companies that were counting on stimulus money to benefit them, perhaps it's been delayed. Perhaps the benefit will be in 2010, more in 2010 than in 2009. If that's the case, Great Lakes should certainly benefit. The company's already seen some nice trends in their business in 2009. I think that can continue into 2010.
Tell me about this kind of balancing act that they do, because they've got foreign business,
Right.
but then they've also got to sort of see what happens in the United States. They've got to move their dredging equipment around the globe in order to take advantage of contracts.
That's right, and the Mideast business that they have is in decline. Backlog is down there. They've repositioned some vessels from the Mideast to the United States. There is a cost associated with that, of course. You saw that in their third quarter report. So I think we're in a sort of transition phase. The Mideast business had been pretty good while the U.S. was weak. Now the U.S. appears to be picking up, and this goes with the fact that they're repositioning their vessels. Again, if 2010 sees that stimulus money flow through, there should be opportunities to put those vessels to work.
All right, and for GLDD, the price, talking about $6 and change right now for
Right.
the stock. What do you think? The stock is worth about $9 a share?
That 9 is our price target, which implies some pretty nice appreciation potential from here. Utilization rates for Great Lakes equipment is less than 80%. So again, no additional costs associated with additional volume or projects that come into their business. Incremental margin should be very nice
All right,
as well.
all right.